All right, Akiko, you mentioned it, the market gains today. The Dow pushing higher, up 369 points, heading for the 7th straight day of gains. The market's digesting a number of positive quarterly results here from bigger banks. Bank of America, Morgan Stanley, Charles Schwab are the standouts today. Half of the companies in the S&P 500 that have reported earnings in the past week are in the financial sector, giving us a good glimpse at the consumer. This is according to FactSet. Let's talk a little bit more about the results we've seen so far. What it signals going forward. For that, we want to bring in Tom Hayes, Great Hill Capital Chairman and Managing Director. Tom, it's good to see you here. So the Q2 setup was similar to what we saw headed into the first quarter. Now that we've gotten even more results this morning from Bank of America, from Morgan Stanley, I guess what are your big takeaways just in terms of the health of the consumer and what it signals?
Better than expected. The bar was very low, and as we know, the secret to happiness in life is low expectations. So we came into Q1 negative 6.2% expectations. We got -2. Analysts had to take their numbers up. The strategists were looking for a drop of 20% in earnings. Instead, we got a rise. The same exact thing. We expected negative 7.1% coming into this earnings season. We're shooting the lights out. The average gain over the last 10 years during earnings season is plus 5.3%, which means we could finish up negative 1.7%, and that's going to force analysts to take their guidance up. And if we look at the next 2 quarters, even now the guidance is plus 0.1% for next quarter, so positive earnings next quarter, and then plus 7.6% for Q4. So a lot of good things coming, but I think they're coming right now.
Tom, give me a sense of what your read is on where we are in this economy right now, based on the numbers that we've gotten so far. I mean, you heard Brian Moynihan earlier saying, look, the consumer has been a lot more resilient than we expected. The economy is still fairly strong, even though things are starting to slow down. What's your read based on the earnings we've gotten so far in terms of where we're headed?
Well, you have an 80% beat rate, Akiko, and you have to keep in mind, people talk about negative money, M2 money supply growth. You had basically 10 years of money supply growth pumped into the economy in 24 months. So that's going to take a long time to work off. And I think that the pessimism is overdone. It's been overdone. Granted, we're up over 25% off the October lows, so we might have some consolidation. But that consolidation could actually look more like rotation. So while the indices may not quite do as well as they did in the first half of the year, being up mid-teens, maybe we'll get mid-single digits to high single digits. Underneath the surface and underneath some of the sectors that haven't participated, and we've talked about the Magnificent Seven, they've started to participate in the last 6 weeks since I've been on, which we talked about last time. That's where the opportunities are going to be. So if you're just jumping into the indices now, you may not be that excited to get 5 or 7 or 8%. But if you're jumping into the 90% that didn't participate the first 5 months of this year, there's huge opportunities. There are going to be stocks up 30, 50+%.
Tom, the beat rates that we've seen so far, is that enough, though, for the market's momentum, this rally, to stay intact? Or are we going to have to see maybe some stronger results elsewhere, economic data that's cooperating with a cooling economy, maybe for the Fed to back off in order to keep that trajectory to the upside?
Well, people were pretty pessimistic coming into the bank earnings. Other than the revenue was supposed to grow 7.8, which was going to be the highest, people worried about net interest income. That's proven to be better. I love what Brian Moynihan said about commercial real estate. People have been so pessimistic that this was going to blow up the economy. And instead, he's like, it's a building by building thing. It's going to work itself out. And these are going to be extended. They're going to be renegotiated. And it's going to depend on the different buildings. The A class are going to do exceptionally well. The B and C class properties, they'll work out and they'll restructure. So a lot of positive things happening. So I think the key is not being tempted with FOMO to chase the things that are up enormously already year to date and look at those things that haven't yet fully participated, because that's where all the money is going to come next. And actually, if we looked at the Bank of America Global Fund Manager survey this morning, it was so interesting. In the COVID lows in 2020, the institutions were so skeptical. After the market rallied from March till June, and it just took off, they still wouldn't get in the market. They were still pessimistic. They were still at high cash levels. Guess who bought those first 4 months? Retail investors got it right off the COVID lows, and the exact same thing is happening right now. The retail investors have been buying. The sentiment has gone up. Institutions actually picked up their cash levels this month. They're still overweight cash and bonds. They have the least risk on since the COVID lows and since the great financial crisis lows. Their growth expectations are still pessimistic. So that is further fuel tool for this market to churn higher on the indices level, but actually for the laggard groups, that's where they're going to have to chase. They're not going to chase what's up if they're already missing their benchmark. They're going to chase those things where there's opportunity.
Tom, we're a week out from the next FOMC meeting. When you think about expectations right now, nearly unanimous in terms of expecting a rate hike in July. Just under 3% think the Fed will hold to a pause. Based on the data that we have gotten since the last meeting, are you in that camp that this is the meeting where we have a hike, but maybe see a longer pause on the other end of that?
Well, Akiko, are you asking me what they should do or what they will do? Those are two different questions, but both are great questions.
What they should do.
What they should do is they should absolutely skip once again and say we're going to look at the data, because they have more than enough cover at this point to justify a skip. When you look at PPI, that was near deflationary levels, up 0.1%. That leads CPI. CPI was a tick off of a 2 handle, and we're still thinking about hiking rates. These things worked on a lagged basis. Between PPI and CPI, they have more than enough cover. You had the lowest job growth with the non-farm payrolls at 209,000 jobs created. You have the U6 unemployment rate at 6.8%. So the lagged effects of the tightening that have been going on for over a year are being felt. Now they just need to sit back and make sure that trend persists and make sure the data keeps going down. So if I was in Jay Powell's shoes, I would say skip, let's see more data, and ultimately turn into a pause. They probably won't do that because it's priced in. The market can handle another hike, but they shouldn't go too far beyond that, because when that lag kicks in, it tends to get aggressive, and right now they've landed this soft landing opportunity, and they could ruin it if they get too aggressive and too feisty.
So if they do 2 more hikes, the odds of a soft landing,
go down materially.
Significantly?
Yeah, it's. I think you'd go down from a 95% possibility of a soft landing to maybe a coin flip.
The data that the Fed should be looking at, obviously inflation, CPI, core CPI, is what they're most closely watching. We've gotten to, on that headline number, not core CPI obviously, but that headline number, to 3%.
Yep.
If we want to see further cooling in inflation, how do we get that? How do we make more progress if the Fed is not going to continue to hike? Or they shouldn't, in your view?
We can't afford to see more disinflation because we have 120% debt to GDP. So the last time we had this much debt in debt service, as you saw the headlines, debt service is now approaching $1 trillion a year. That's huge. Last time we had debt to GDP at 120% was following World War II. And the way that they got out of it was through nominal growth. They let inflation run between 3 to 5% for 5 years. And debt to GDP collapsed from 120% down to 63% in just a handful of years. That's the playbook they should be following right now. Acknowledge that, continue to talk hawkish. We're going to take it down to 2%, but let it run a little hot so we can bring the debt to GDP down and have it at sustainable levels, have nominal growth run hot, and all will be well. So hopefully they're following that playbook and they're reading enough history books to continue. They've got a win here that, don't snatch defeat from the jaws of victory. They got a clear win here. Skip it. If they won't skip it this month, then just go into a pause after this month would be great.
Tom, we started by talking about the banks. Financial is one area that has really benefited from the Fed's rate hike cycle, obviously, because of the income earned on those rates. There's another area, though, that's been hit hard by the Fed's hiking, and that's REITs. I mean, what's your investment thesis around that right now?
Okay, so great question, Kiko. There are 2 themes that we're looking at now that the Fed is wrapping up. Whether they should have wrapped up at the last meeting, so they'll wrap up at this meeting. Number one, the dollar downtrend that began in October is going to continue, okay? So that's already happening. We had a short bid to safety in advance of the debt ceiling just a few weeks back. That's now rolled back over. So with the dollar weakening, we like multinationals that get up to 50% or more of their income from abroad. Those increased earnings are really not baked into future estimates. We're gonna start to see those come through in the second half of the year. We like emerging markets is gonna work with a weak dollar. Emerging markets, China, and risk on with biotech. Now, as it relates to REITs, the second theme besides weak dollar is that we're going to see the middle end of the curve to the long end of the curve, the 10-year, start to get bid which will compress rates. That helps a number of things. That helps regional banks with their mark-to-markets. That helps REITs start to get bid because they're interest rate sensitive. And I know we were on a couple of months ago talking Vornado, and people looked at me like I had 3 heads, but they were kind and polite. And Vornado's up now 30, 40% since then because the high-quality businesses will do well. The B and C properties we're not so sure, but the A properties are going to do well. This is very similar to the mall crisis of 3, 4, 5 years ago, where everyone said all these malls are going out of business. The B and C properties did go out of business. The A properties, like Simon Property Group, that have Apple, that have Lululemon, did exceptionally well. We think it'll be the same case for commercial real estate REITs with A-class properties like Vornado, which we own.
Okay, Tom, stick around there, because on the other side, we're going to talk a bit about your picks and some that you say to stay away from. Hint, generative AI and the hype around that. Going to be part of that thesis. We're going to continue that discussion on the other side.
Super. Right, thanks. Well, big banks coming out strong so far this earnings season. Bank of America shares trading higher, up just about 4%. The company beating on profits and revenue for its most recent quarter. Net income up 19% from a year ago. The bank is a top stock pick for our next guest. We want to bring back in Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, we just heard from Bank of America Chairman and CEO Brian Moynihan earlier in the hour, telling us that he's not surprised about the fact that the consumer has been and will continue to be resilient. What's going to be the catalyst here for Bank of America? Is it the consumer from here on out?
I think it's a few things. I think expectations are very low, and I think the stock has already been derated. So Bank of America trades historically at about a 12.5 times multiple, below the S&P on average. It's now trading at about 8.8 times as of this morning. We bought this stock during the mini banking crisis in late March. We were looking in the rubble for dislocation, and we said when there's periods of dislocation, we benefit by buying the highest quality, and that's what Bank of America is, and that's certainly what Brian Moynihan is as the CEO for sure. So first off, it's been derated. It's trading at about 1 times book, which these stocks throughout a cycle can trade from 1 time at trough to 2 times at peak. So there's a lot of runway for the valuation re-rating. And I think generally the other thing that he didn't really talk about that they didn't touch on is they took their loan loss provisions were lower than expected this morning. Everyone thought it was a foregone conclusion they would have to take them up a little bit because people are so panicked about commercial real estate, about credit cards, and in fact, they took them lower than expected. So I think the quality of their business, the quality of their book is good. And as that 10-year gets bid, which we talked about before, all their mark-to-market with their loans, with their portfolio holdings are going to go up. So that's going to be an additional benefit for Bank of America. So it's best in class. We love it. We think Brian Moynihan is a tremendous leader. And having seen how he worked the bank through the financial crisis, he and Jamie obviously are the best 2 in class. Yeah.
So, that's kind of my natural follow-up here, Tom. You talk about B of A being best in class, but is this a play that, maybe those who are watching can say, look, should I be looking at other financials too? How much of this is a B of A specific story? How much of this is about a second look, broader financials?
Yeah, so what we like to do is we buy high quality when it's on sale. So JP Morgan is high quality, but it's not quite as discounted as Bank of America is. We like it trading right around book. We like it trading at 8.8 times earnings. We like Brian Moynihan. However, the second, we did 3 financial plays during the mini crisis in March. One was Bank of America, one was Vornado, which we came on and talked about. Shawna remembers very well. And we also put on a trade with the KRE. We couldn't pick which small regional bank would do well, so we decided to buy the whole basket while it was dislocated, and that started to work out nicely. We think that's going to persist because as the 10-year gets bid, all the mark-to-markets on those banks are going to go up, and you're going to see a bid into small caps, which is 21% financials, and we think that group is going to continue to perform. So as it relates to the smaller banks, we like a basket. As it relates to the large money center banks, we like one pick, and that is Bank of America in terms of upside relative to price.
All right, Tom, let's switch industries just a bit. Talk about your next pick, and that's Cooper Standard, a stock that has actually done very well since the start of the year. Yeah. What's the bull case going forward?
Okay, this is a little-known stock. We actually modeled this off of Charlie Munger did a similar trade during the recession of 2001. He bought a company called Tenneco. Tenneco had fallen from $16 down to $1. Cooper Standard during this recession had fallen from $146 in 2017, 2018 at peak auto production when they were earning $7.21 a share. They fell all the way down to $3.50. We initiated a position last May around $5.50. The bad news is it's up 3x, about 200%. The good news is we believe it's just getting started. Why do we think that? Because they were able to refinance their debt out to 2027, so that the solvency risk is off the table, which was a key factor. Stock doesn't go from 146 down to 350 if that's not a real risk. So they took care of that, and now auto production is starting to normalize, and we believe it's going to normalize. If it gets to 85 to 90% of 2017 levels, we believe this stock can earn $7, $8 a share again. Now, at its peak, it had a 20 times multiple on those $7. That's why it traded up to 140. Let's say it doesn't get a peak multiple again, and it gets to $7 of earnings power, and it trades at a trough multiple of 10 times. You still have a $70 stock. This stock is trading at $16.24 today. So yes, it's up a lot since we went public with it. And we think it's just getting started because all the risk is now out of the stock, and now you just wait quarter by quarter for margin improvement, and more importantly, because management is delivering. They can deliver. All you need to see is the industry volume production. We saw it. General Motors sales were up 19% last quarter. Industry sales are up. We saw it a little bit in retail sales today. And you're going to see more and more incentives from the OEMs. So in a 7 or 8 or 9% environment, we think used cars are going to struggle, but when you're seeing it all over the TV, 0% APR, 0.9% APR, 1.9%. Before the pandemic, no one cared because money was free. Now that money has a significant cost, rather than buy the used car, you're going to buy the new car and get free financing, and that's going to do very well for Cooper Standard, which provides all the sealing systems around the windows and glass, fuel, brake delivery systems, fluid transfer systems, all to the new car producers. So we're pretty excited about this, and we're going to ride the wave in a leveraged way for the pent-up demand, because the average car on the road is 13.7 years old, so people need new cars.
Tom, let's talk about some stocks that you're not as excited about. Okay. Apple at one of those that you've picked out. Is this a valuation issue? Because this is, I mean, Apple is one of those sort of those steady stocks, yeah, right? I mean, is this just about the run-up that we have seen in tech overall?
Yeah, so these are two of the greatest businesses in the world. So, we're not shorting these stocks. Our base case is that we're going to continue to see a rotation in the second half where the stocks that ran up the most in the first half are going to perform less well. It doesn't mean they're going to crash. It doesn't even mean they're going to go down. It means that they're going to underperform relative to the catch-up trade, some of the groups we talked about, financials, small caps, et cetera. When you look at Apple, though, objectively, they're growing earnings. Their long-term earnings growth rate for the next 5 years is expected to be about 7.9%. They're trading at 32 times earnings. Now, you can say, well, it's the greatest company. They should have a premium. Yes, they should have a premium. But over the last decade, most of the time they traded, their multiple was in the low teens because they had the low earnings growth rate. And that implies a 3 times price to earnings growth rate PEG ratio, which is a little rich. So all we're saying here is for new money, we wouldn't be chasing this stock. We would certainly be strongly considering it if it came down at a lower price, but you may never get that big discount. We're just saying underperformance for the second half on this front.
Tom, I'm guessing you're going to have a similar stance as to why you're not liking NVIDIA, given the price evaluation and the massive run-up that we've seen over the last several months. Well,
look, again, NVIDIA is a great business and going to continue to do well as a business, and they're growing earnings actually at 21% long-term expected growth rate. So the 59 times PE is slightly more justified, but at 24 times sales, I literally just can't stomach it. Maybe I'm old-fashioned, but I can find better things to do. I look for, very simple businesses that I can understand for doubles and triples over a reasonable amount of time, 12 to 24 to 36 months, and I'll leave the shiny new objects for others to discern. But great business, just a little too rich for my blood.
And those who got in early are certainly having the last laugh now with that massive run-up since the start of the year, over 200%. All right, Tom Hayes, always great to have you. Thanks.
Thanks for having me.